Professor Nam Yong Lee's long-form commentary, while TSMC is raking in money with software-type non-memory semiconductors, Samsung cannot survive on hardware-type memory semiconductors alone. The essence of the semiconductor industry's two faces that changes the game comes down to whether it is hardware-type or software-type. Memory semiconductors are a thoroughly hardware manufacturing industry that supplies the same function more cheaply, in greater volume, and with higher stability. Profitability is driven by process scaling, yield, equipment utilization, and inventory price cycle management, and the same structure repeats. Cash flow surges in boom times, but margins collapse in downturns. In that structure, factory expansion and depreciation burdens periodically tighten a firm's breathing room. Non-memory semiconductors are a software industry that designs what the system will compute. Across CPUs, GPUs, NPUs, SoCs, communications, power, analog, sensors, and automotive chips, functions split, recombine, and explode into countless product families. The core is not the process alone, but a comprehensive platform capability that intertwines electronic design automation, EDA, intellectual property, IP blocks, process design kits, PDKs, advanced packaging, and embedded software. Accordingly, hardware-type memory is governed by the physics of process, equipment, and logistics, while software-type non-memory is governed by the logic of ecosystems, standards, toolchains, and developer productivity. TSMC is the company that implemented the latter as software-type system semiconductors, including foundry services, while Samsung Electronics has pushed forward by leveraging electronics and machinery-centered manufacturing capabilities to drive hardware-type memory semiconductors through sheer volume and quality. In the end, the decisive battleground for both companies is competitiveness in the non-memory software-type semiconductor industry. The non-memory market is currently estimated to be about 3 to 4 times the size of the memory market, and the gap is expected to widen to more than tenfold in the future. As of 2024, reported figures indicate that non-memory accounts for roughly 74.8% of the global semiconductor market, implying that non-memory versus memory has already opened to about a 3-to-1 split. An analysis pointing to about 23.88% memory and about 76.12% non-memory in 2022 aligns in the same direction. The total pie of the semiconductor market is also expanding. WSTS projected the market at about $611 billion in 2024 and about $700,900,000 in 2025. As the pie grows, non-memory with expanding functionality is likely to sit at the center of the pie, whereas memory may see its profitability shaken by price cycles even if demand rises. This line of argument contends that over a 20 to 30-year horizon, 2045 to 2055, the gap will widen to tenfold or more. In other words, even if the number of memory bits per device increases, the combination the overall system demands, compute, communications, power, sensors, security, packaging, and accelerators, must grow far more steeply. If that condition holds, a structure where non-memory approaches 90% of the whole is theoretically possible, implying a gap on the order of around ninefold. Why is TSMC classified as software-type manufacturing? TSMC's essence is not a factory that stamps out wafers, but a development platform that provides productivity and reliability so that customers' required designs succeed. More important than the number attached to a process node is design process co-optimization that enables customers' required designs to tape out faster and ramp to mass production at higher yield even on the same node. That cannot be achieved by fab floor equipment alone. Software-side design rules, models, libraries, and verification flows must be one body with fab operations. For this platform to work, computer engineering and software engineering thinking is essential. Customers' software design assets must connect with manufacturing data, defects and variation must be learned statistically to reduce risk for the next product, and a tool chain must run that raises design productivity together with customers. At that point, TSMC becomes a software-type semiconductor manufacturer, fabless-like in behavior or foundry in form, while simultaneously transforming into a systems industry that sells a development environment. TSMC's performance is confirmed by numbers. TSMC's revenue was $90.08 billion in 2024, $69.30 billion in 2023, and $75.88 billion in 2022, with a sharp rebound in 2024. In 2025, it disclosed that second quarter revenue rose to $30 billion and $7 million, up 44.4% year-on-year, and third quarter revenue rose to $33 billion and $10 million, up 39.0% year-on-year. Why is Samsung bound to hardware-type manufacturing? Samsung Electronics has accumulated world-class manufacturing capability in memory, and its success formula is strongly anchored in the physics of process, equipment, materials, quality, and mass production operations. That strength remains valid, and with the spread of AI servers, there are also phases where high value-added memory such as HBM lifts profitability again. However, there is also the trap of an integrated device manufacturer, IDM. In non-memory, customers increasingly choose partners based on the probability of success across the entire chain: design, manufacturing, packaging, and software. In that environment, a memory-centered organization and its KPIs can repeatedly encroach on the speed and priority of a non-memory platform. In other words, if a culture hardens where factory optimization beats customer development optimization, defeat in non-memory becomes structurally predetermined. Financial flows reveal this tension directly. Samsung Electronics' annual revenue swung sharply with the cycle, 302.23 trillion won in 2022, 258.94 trillion won in 2023, and 300.9 trillion won in 2024. Ultimately, it is now being overtaken in revenue scale by TSMC, which started as a venture. In 2025, there were reports that semiconductor division profit plunged in the second quarter, suggesting that if HBM supply delays, export restrictions, and one-off costs align, the vulnerability of an integrated organization can become sharply visible. The customers of both TSMC and Samsung Electronics are US big tech firms. These firms are called fabless. Big tech develops the concept of products and services through systems engineering and software engineering, separates system requirements into HWCI and CSCI, designs accordingly, and then places orders with a foundry-type producer such as TSMC. For example, where major customers like Apple and NVIDIA and countless fabless and IDM customers choose to place tape-outs determines the gravity of the ecosystem. Foundry customers do not look only at unit price, they simultaneously evaluate software design capability, schedule, yield, packaging, supply stability, and IP compatibility. There is also the EDA IP ecosystem. For designs to succeed at leading-edge nodes, verification, physical design, power, timing, and reliability toolchains must mesh with the process. And if that linkage is weak, a hardware-type semiconductor manufacturer can cause customers' development cost and time to explode. By contrast, a software-type system semiconductor platform company like TSMC reduces customers' failure costs and in return gains pricing power. There is the equipment, materials, packaging domain as well. Especially in the AI era, advanced packaging rises to the front, and wafer processing alone cannot complete system performance and shipment volume. Who controls packaging capacity determines customers' shipment volume, which in turn determines the speed of revenue recognition. Investors look not at technology itself, but at the probability pathway by which technology converts into cash flow. With platform-type software-type non-memory. If the ecosystem locks in, revenue tends to follow as capacity expands. But with hardware-type memory, once the price cycle turns down, capacity becomes a shackle. Whenever an investment culture ignores this simple structure, the assets of our citizens are consumed while tied to hope. The investment logic seen through both companies' revenue trends is acceleration versus volatility. TSMC rebounded to $90 billion and $8 million in revenue in 2024, and in 2025, its quarterly revenue climbed to $30 billion and $7 million in quarter 2 and $33 billion and $10 million in quarter 3. Monthly revenue disclosures also indicate that cumulative revenue from January to September 2025 increased 36.4% year-on-year, suggesting that the direction of growth is tilting from cycle towards structure. Meanwhile, Samsung Electronics was reported to show a quarterly flow of about 79.14 trillion won in Q1 2025, 74.6 trillion won in Q2, and 86 trillion won in Q3. There were also reports that semiconductor division profit improved significantly in quarter 3, again confirming how large the earnings leverage is when the memory cycle turns upward. From an investment perspective, the key conclusion is simple. TSMC's revenue tends to accumulate structurally as customer-required designs increase and as the mix of advanced process and packaging rises. Samsung's revenue can explode when the cycle rebounds, but the market repeatedly prices in the risk that cash generation durability may weaken in the next downturn. Now look at stock price, valuation and forecast coldly using only numbers. TSMC, ADR TSM, was shown at $276.96 as of December 18, 2025. Forward PE multiples in the low to mid-20s have been cited. This multiple does not merely reflect the belief that AI demand will not fall, but rather the judgment that cash flow visibility rises as customer designs become anchored to a specific platform. Samsung Electronics 005930 was shown at 107,600 Korean won as of December 18, 2025. Statistics indicating a forward PE around 9 to 10 have also been observed. This seemingly low valuation suggests the market still views Samsung's cycle risk as substantial, while also implying that there is room for re-rating if a shift toward a software-type non-memory platform is proven in real results. Forecasting for 2026 to 2030 in a single number would instead mislead ordinary citizens. A rational approach is scenario-based. Based on 2025 quarterly revenue momentum, $30.07 billion in quarter 2 and $33.10 billion in quarter 3, TSMC has a trajectory that could approach around $120 billion in annual revenue, but downside risks include geopolitics, export controls, and margin dilution as large overseas fabs ramp. Samsung could see profit stamina recover sharply if the memory upcycle persists, but if delays repeat in HBM, advanced packaging, and customer qualification, market trust could remain constrained even during rebounds. Samsung's transition roadmap and an investor checklist must therefore be examined. The first prescription Samsung must execute is to break the habit of trying to transplant the memory success formula directly into non-memory. In non-memory, customer development success rates matter more than factory efficiency, and design process packaging software must be operated as if it were one product. To do so, the non-memory organization should be evaluated not by manufacturing KPIs, but by metrics such as customer tape-out speed, design reuse rates, qualification pass rates, and packaging turnaround time. The second prescription is to elevate advanced packaging from being a subsidiary of the process to being the core of the platform. In the AI era, the bottleneck increasingly erupts in the package rather than on the wafer, and securing packaging capacity directly determines customers' revenue. If the contest is decided there, the the cash earned in memory will not become seed money to build a non-memory platform, but will instead be consumed as the cost of a war of attrition to survive the cycle. Ordinary investors need an even colder checklist. For TSMC, one must examine customer concentration, advanced node ramp speed, packaging bottlenecks, and the geopolitical risk premium at the same time. For Samsung, one must verify HBM and advanced node customer qualification, a structural rise in the share of software-type non-memory revenue, and the durability of quarterly earnings. Before numbers prove the structure, no one should wager assets on emotional patriotism or trendy slogans. In closing, the conclusion is clear. Even today, in 2025, software-type non-memory is observed to be about 3 to 4 times larger than hardware-type memory, and over the 2045 to 2055 horizon, this gap is likely to widen by more than tenfold. TSMC is redefining manufacturing with software platform logic and building a gravitational field of growth, while Samsung faces the risk of remaining merely a good factory if it cannot convert its memory strength into a non-memory platform. Samsung Electronics must rearm itself, moving from a thoroughly hardware manufacturing mindset to a creative software development mindset. As a final admonition, there is no other path than to completely replace senior executives and business owners on the critical lines, currently dominated by mechanical engineering, electrical engineering, and electronics majors, with leaders trained in computer engineering, systems engineering, and software engineering. Thank you for watching Professor Nam Yong Lee's long-form commentary.